In 2026, the average British pensioner withdraws somewhere around £2,500 in cash every single month. That money goes to the weekly shop, the car park, the grandchildren, the workman who comes round to fix the boiler. Most of it moves through the system quietly, with no flags raised on any account. But there's one specific way of withdrawing your own money from your own bank that can trigger something far more serious than most pensioners ever imagine: a formal review by HMRC, and in some cases by the Department for Work and Pensions too. And here's the part that surprises almost everyone. The trigger isn't usually one big withdrawal or an unpaid bill or anything dramatic. It's something much smaller. A habit repeated dozens of times a year, completely innocently, by people who genuinely believe they're being careful. I'm Thomas Ashford, and over the next few minutes, I'm going to walk you through the exact banking pattern that catches more retired people out than almost anything else. We'll go through 5 completely ordinary situations where pensioners fall into it without realizing. I'll explain why it's treated so seriously, and by the end, you'll know exactly what to do differently, starting today. To understand why this matters more in 2026 than it used to, you need to understand what changed in UK banking over the last couple of years, because almost nobody has explained this properly to ordinary retired people. Every UK bank operates under money laundering regulations that legally require them to monitor your account activity, every withdrawal, every deposit, every transfer, and to flag anything that looks unusual. Think of it less like a person watching your account and more like a security camera in a shop. It records everything, but it has no idea about context. It just sees patterns. When something matches a pattern the software's been trained to flag, a report gets generated automatically and sent onward for review. No human at the bank decides to do it. The software does it on its own. Until recently, this mattered mainly for tax purposes, but more recently, the DWP was given expanded powers to request account information from banks in certain circumstances, particularly where someone is receiving means-tested benefits like pension credit or attendance allowance. What that means in practice is that a banking pattern which used to only matter for tax reasons can now matter for benefit reasons too, because it might be treated as evidence that your circumstances have changed, and that can affect your benefits while things are being looked into. So the stakes around how you handle your own cash have quietly gone up, and hardly anyone's talking about it. So what's the one habit that catches more pensioners than anything else? It's something the law calls structuring, and it's the exact opposite of what most people assume is the sensible, discreet way to handle money. Here's how it plays out. Most pensioners, when they need to take out a larger amount, instinctively break it into smaller withdrawals. 1,000 today, another 1,000 on Friday, another 500 next week. It feels careful. It feels like the quiet way to do it, rather than walking in and asking for £4,000 or £5,000 in one go, which feels conspicuous. The truth is the exact opposite of that instinct. A series of smaller withdrawals spread across days or weeks is treated by banking software as more suspicious, not less. One £5,000 withdrawal, with a reason given at the counter, usually just goes through, and that's the end of it. 5 withdrawals of £1,000 each across 2 weeks looks, to the software, like someone deliberately trying to stay under the radar, and that pattern gets flagged automatically. The reason this catches retired people specifically is simple. Pensioners often withdraw smaller amounts because that's simply how their week works, with absolutely no intention of hiding anything. The system doesn't know that, it just sees the shape of the pattern. Let's walk through the 5 situations where this happens most often, completely innocently. The first is helping a grandchild with money. Picture a grandparent in their 70s with a granddaughter at university, struggling a bit. They withdraw £300 and hand it over one weekend. A week later, she mentions new tyres, so another £400 comes out. A couple of weeks after that, her boiler breaks and another £600 goes out to help. None of these are large on their own, But to the software, a pattern of irregular cash withdrawals with no visible explanation looks exactly like structuring. Here's the fix. If you're helping a family member regularly, avoid cash where you can. A direct bank transfer with a simple reference like gift or support creates a clear paper trail because the software can actually see where the money went and why. Under current gifting rules, you can also give up to £250 to as many individuals as you like each year, plus one £3,000 annual exemption without any tax implications at all. There's also a lesser-known rule. Regular gifts from surplus income, meaning money you don't need for your own living costs, are treated differently from irregular cash handed over on random days. A standing order of £300 a month is viewed completely differently to £300 pulled out in cash on 3 separate Fridays. The second situation is paying a workman in cash. Someone needs the roof fixed, agrees a price of around £2,000, and the roofer says he prefers cash because transfers take too long to clear. £800 comes out for a deposit, then £600 a few days later, then a final £600 when the job's done. 3 withdrawals over about 8 days, all cash, all similar amounts, exactly the profile the software is built to notice. There's a second layer to this one worth knowing. If a workman insists on cash, it's often because they'd rather their own income wasn't easily traceable either. And if your withdrawal gets looked into and their name comes up, you can end up caught in the middle of something that has nothing to do with your own affairs. So here's the simple fix. Ask for a written invoice with their name and business details before handing over any money. A legitimate tradesperson will have no problem giving you one. The third is buying a car with cash. Someone finds a car for £8,000, gets offered a small discount for paying cash, but doesn't want to walk in and ask for £8,000 in one go, so it comes out in stages over a fortnight, a couple of thousand at a time. To the software, that's a textbook structuring pattern, even though there's a perfectly innocent car sitting on the driveway proving where the money went. The fix here is simple. Tell your bank in advance. Every major high street bank has a process for large planned cash withdrawals. Give them a few days' notice, explain what it's for, and take it out in one go. A single documented withdrawal with a known purpose is treated as a normal request, not a red flag. The fourth is one of the hardest, paying for a funeral. When a spouse passes away, the surviving partner suddenly faces a string of payments in a matter of weeks. The funeral director's deposit, the cars, the venue, the caterers, all while they're least equipped to think about how their bank account looks from the outside. Multiple cash withdrawals over a short window, right after a joint account holder has passed away, is one of the patterns the software flags hardest, with absolutely no understanding of what's actually happening in that person's life. The practical fix: pay the funeral director directly by bank transfer wherever you can, and ask for a single invoice covering the full amount. Keep every receipt together in one place. Most funeral directors are completely used to working this way, and it gives you one clear, simple paper trail if anyone ever asks a question. And the fifth is giving money for a wedding or big family milestone. Grandparents wanting to help with a wedding might give £2,000 toward the venue, another £1,500 for the honeymoon, and a bit more on the day itself, spread out over the months leading up to it. Here's the cruel irony. UK gifting rules are actually very generous for weddings. A grandparent can give up to £2,500 toward a grandchild's wedding, completely free of any tax consequence, on top of the usual annual allowance. The gift itself is entirely legitimate. It's simply the way it's delivered, cash in pieces over time, that looks identical to structuring, even when HMRC has already carved this exact gift out as exempt. The fix is the same as before. A bank transfer, a cheque, or a building society draft. Any of these documents both the amount and the recipient and removes the concern entirely. So now that we've covered the 5 situations, let's talk about what actually protects you, starting today. There are 3 principles worth remembering. The first is consolidation. Wherever possible, replace several small withdrawals with one larger, planned, documented one. Give your bank notice, explain the reason, and take it out in a single visit. The second is documentation. Every time you make a meaningful cash payment, get something in writing. An invoice, a receipt, even a text message confirming the amount and purpose. Keep them together in one place. A simple folder in a drawer is genuinely enough, and it can make all the difference if anyone ever asks a question later. The third is preferring electronic transfers over cash wherever you reasonably can. A transfer with a clear reference tells its own story: the destination, the purpose, the relationship. Cash handed over in person tells the software nothing at all, so it assumes the worst by default. Together, these three habits, consolidating, documenting, and preferring electronic transfers, keep almost anyone comfortably clear of this, regardless of how much money moves through the account. Now, quickly subscribe if this is genuinely useful to you, because the next section covers exactly what to do if a flag has already happened to you. If you've already had a letter asking about withdrawals on your account, the worst thing you can do is panic, and the second worst thing is to throw away old receipts or statements. Keep everything: till receipts, notes from workmen, cards mentioning a wedding gift, texts confirming a transfer. The whole matter usually comes down to whether you can show the purpose of the money, and you'd be surprised how much of that evidence already exists in the ordinary paperwork of daily life. The next step is simply to write back calmly, in plain English, explaining the general nature of the withdrawals and offering to provide documentation if asked. Stick to what's actually been asked, rather than guessing at more. In most cases, a single, clear, calm letter like that resolves things quickly. And if you ever feel out of your depth, Citizens Advice offers free appointments and has real experience helping with exactly this kind of correspondence. Everything we've talked about today comes down to one simple idea. This isn't about spending less or being suspicious of your own habits. It's about documenting ordinary, honest spending in a way the system can actually understand, so a completely innocent pattern never turns into weeks of unnecessary stress. If this was useful, hit subscribe, because I go through exactly this kind of thing every week. Turn on the bell icon so you don't miss the next one. And please share this with anyone in your life who handles cash regularly: a parent, a grandparent, a neighbour, because this is the kind of thing that helps far more people once it's actually been explained properly. I'm Thomas Ashford. Take care of your money and take care of your records. I'll see you in the next one.